John, thank you for taking time being with us today. Tell us a little bit more regarding your background and how did you get into real estate?
So I started actually in finance, and while I was a financial advisor, I decided that I didn't want to do that anymore. I just didn't believe in the product, selling stocks and bonds. Although they're great investments, it just wasn't for me. It wasn't what I wanted. I didn't believe in it. I had no control in it. It was sort of just, selling someone else's story and having somebody buy into that story. So while I was a financial advisor, I decided that just doing a lot of reading and, all those things that pop up and I'll go to this course and read this. I just started reading a lot about real estate, and I thought that that was a great opportunity. And I started reading, and then, I was relatively successful in the grand scheme of things. I took a lot of the money that I made as a financial advisor, and I went out and I started buying tax deeds. And then that was like the addiction, and just real estate just really took off from there. I saw, what you could do and how you could do it. And then, I went from tax deeds, became a residential agent, became a commercial broker, selling multifamily buildings in Ridgewood and Bushwick. And then saw what my investors and clients were doing and wanted to be on the principal side. So I transferred over to the principal side by using my financial background with raising money, as well as my real estate experience. And then we went out and bought a 48-unit building in Columbus, Ohio.
Gotcha. Jumping a couple of steps here. So how does one go from a financial advisor to tax deeds? What was going on in your the thought process of saying, let's go do tax deeds?
Yeah. So I when I was doing a lot of research, you always look and say, I want to fix and flip a house, and it was all interesting stuff. I didn't know anything about it though. I didn't know how. I didn't know if something would cost me 20 grand. I didn't know if it was going to cost me 150 grand. Tax deeds seemed interesting to me because you could get involved for relatively cheap. And if I was going to take a risk on something that I wasn't 100% familiar with, I wanted to go the cheaper route. And, the first tax deed I bought was $350 or $362. So, I did a lot of reading, a lot of, what was I going to buy? Was I going to buy notes or so on and so forth? And then I just felt that the tax deed, you could buy a property back for the delinquent taxes. And I was like, that seems really interesting. So that's the first, that's the first thing that I did.
And what returns did you get from the first tax deed that you bought?
That was a complete loss. I bought something, and it wasn't it was I went to the auction for a learning experience, but then you're sitting down in the auction environment, and everyone's bidding and putting their hand up and raising their hand. So I said, you know what, you're getting excited. I had some money in my pocket, and they used to use a lot of auctions used to be able to go in with cash, and now a lot of the places I go, you can't do that anymore. But they said, lot 105, parcel, opening bid $360. I was like, $362. Nobody else stood up, and I was like, uh-oh. I either bought something that's nobody knows about, or I made a mistake. And I got you go up, you fill it out, they give you the information, then you got to go try and find the property. And it was worthless. It was zero. But that was the first one. And then after that, we started to, learn what not to do and what to do. And then we started doing a little bit better.
But where was the property? Is it just some in between parking lots?
That's exactly what it was. It was actually, so I went down to, they don't give you the address. They literally give you the section, block, and lot. And, okay, that's great. But now you have to go find the property. So I went down to the county. One guy's like, you don't know what you're doing, do you? I said, I don't have a clue. He's like, let me show you how to do this. So it was actually in a small county in Pennsylvania. And so they didn't even have computers or anything. They literally had maps hanging. You take the map off the wall, you put it on the table, that you got to flip pages, you find it, and then I went to take a picture on my phone, and the clerk was like, "Oh no, you got to pay $10 for a copy." So it was a little bit more money that I had to pay, but literally they give you a map, and you circle the lot, and then you go drive, and it would happen to be a little piece of property in between two houses, and it had like a utility box, like those little like a box just sitting there. So at first I thought the utility company's renting it, I might make some money. No, it was an old thing. It was not working. It wasn't in use anymore, so on and so forth. And then long story short, I went to the neighbor's house. I knocked on the door. I was like, hey, you want to buy the piece of property, to add to your lot? Because that's what they said to do in the book that I read. He said, nope, not interested. And then I walked to the next door neighbor's house. I said, hey, your neighbor just put a bid on the lot, and do you want to buy it? And he said, no, he didn't. I said, well, yes, he did. I have an offer right here in my hand. He said, he didn't put an offer. He's like, you're the third person to come by in 4 years trying to buy that piece of property. And I was like, fair enough. I said, you win. Thank you very much. The tax bill came in the next year, and what did I do? I just didn't pay the taxes, and it probably went back to auction. So you live and learn.
Off to the next sucker, basically.
Exactly.
And how does one go from tax deeds to trumping the land baron?
So that's a great question. After I did that, I realized that it was fun. It was, but you spend a lot of time researching the properties, and you go to an auction and you don't know if you're going to win one or not. I mean, you could only bid as high as you think that it's worth. And, there's 200 people at these auctions sometimes, and sometimes you win, sometimes you lose. So I was putting in a lot of time. And we did well. I had over 150 houses in Pennsylvania, or lots and houses in Philadelphia. So we did well, but, sometimes you win, sometimes you lose, sometimes you break even. And I just saw that you're only as good as your last deal. So if you bought a house and you sold a house, you had no income coming in. So I wanted to try and find something that, generated income on a monthly basis. And, the only thing that made sense to me was rentals. And I own a little single family house in Pennsylvania that we rent to athletes. My brother went to school there, so we rented out to his whole. He played rugby, so we rented out to the rugby team. So I said, yeah, look, this thing's bringing in money every month. How can we do this on a larger scale? Because I don't, let's go buy houses in college towns. That was the first thought I had. But financing is not always the easiest thing in the world. So then it was, okay, become a broker. Let's make some money while we figure out what we want to do. And then I just saw what my clients were doing when I was at Marcus and Millichap, and I said, "This is where I want to be." I flipped some houses in between, and then I just said, I want to be a landlord. I want to be a property owner. So I sought education. I educated myself. Continued to go about doing that, and then that just led me down the path of buying multifamily property.
And how did you knock down your first deals? Run us through the numbers.
So the first deal I bought was a 48-unit property in Columbus, Ohio. It was about 70% occupied, and half those tenants were paying. So it was a pretty rough deal.
A D thing? A D type or C? Or?
I would say it was a solid C property.
Okay.
Now it was a solid C property. I mean, if some people would say it was a B minus, but no, it was a C property. And the tenant base was even worse. The tenant base, there was a lot of crime, a lot of drugs. It was bad. I mean, I have stories that, walking into units and I was like, oh my God, what's going on here? But the first deal we bought it for $1,085,000. We put in to the property another $250,000, maybe a little bit more than that. And what we did was we completely re-tenanted the property. I think when we sold it, I think we only had like 10 original tenants, maybe 8 or 10 original tenants. There was 6 down units that were, there was mold and down to the studs. So we got those back online right away, and we actually got a rent premium for them, which we got. But the problem we made is we still had bad tenants there. So we had actually good tenants move in and good tenants leave because they saw what they lived with. So we had to go start over again. So we went back to the drawing board. We did the whole exterior. So first we cleaned out the property. Basically, if you didn't pay your rent, you were gone. We wanted to train the tenants there to pay their rent on time. So we're offering some incentives. Hey, if you pay your rent 3 months in a row, we'll give you a gift card to Walmart or whatever it is. But we did 3 new parking lots. We did a brand new sign. We painted all the front doors. We did all new numbers. We cleaned up the entire exterior of the property, added lighting to make it, bright at night so you could deter some crime. And then we started turning the tenant base. And then we turned the tenant base, and about 18 months later, we sold it. We were all into the deal for about 1.35, 1.4, and we sold it for about 1.8 and change. That was in 18 months.
But how did you get the capital? And when you say we, because it sounds from the initial story you started alone, so in between you got a team. Can you run us through this? You're jumping a couple of steps here.
Yeah, no, excellent question. So when I say we, I'm talking about all my investors. So, all the deals we do are in, it's a private equity investment. So anyone that either has some capital that's an accredited investor, they can invest in our deals. So I always refer to it as we, because without any of them, there's no way I can do this. Because, the equity that we needed for our first deal was just about 600,000. It was 580 grand. So I raised that through friends, family, coworkers, old employees, and that's how I put that money together. And, I had a property manager on site. I had a contractor in Ohio that would do all the heavy lifting for me. I would fly to Ohio on a monthly basis to check in to make sure everything was going right. But yeah, I raised that money just, I educated myself on the market, educated myself on the business. It took me 6 months to find the deal and then another 6 months to close. Now, the property to close was a disaster. The seller didn't care. He had no records. There was a tax lien on the property. It was a disaster. But in that 6 months for closing, that's when I went out there and walked the whole units. And then I came back, put a presentation together, and spoke to all the people in the deal. And that gave me money. Now, one of my investors, my father and myself, we co-signed the loan. So that's how we got the finance. We had an $850,000 loan. We had a $600,000 investment, or actually a little bit less than that. So we were all into the deal for about 1.4. And then it took us about 18 months to get the whole project from, re-tenanted it, renovated, get it back leased up, stabilize it, and then sell it.
I got a couple of questions here, because I haven't done my first deal, but I'm sending a couple of LOIs from what I believe to be good deals to close. But then you get to the purchase and sales agreement, and so some of them are a little bit sketchy, and some of them that from the read that you get, they're like 80% to take care of the seller and not so much of the buyer. So what I'd like to know is, what do you look for regarding purchase and sales agreement in a way that you don't get harmed and don't harm your investors in the process?
That's an amazing question. I've done a ton of podcasts, a ton of interviews, and a lot of people ask me questions, and that one is, one of the critical ones, because that's how you can get hurt. So the big things that we put in all our contracts is obviously a way to get out of the contract without it costing you a serious amount of money. Now, if you do sign a contract, you're going to have to fly out there. You're going to have to do due diligence, which is going to cost you something. But you don't want to lose your deposit. You don't want to, have them sue you or anything like that. So the big things that we put in there are, depending on the type of deal, we'll put an occupancy clause in there. So let's say the property's, 90% occupied and you want to get stable financing, you don't want the property to drop down to 75. So we'll put an occupancy clause in there. Says you have to maintain credit-worthy tenants under this guideline. So then it's, they don't just stuff tenants in there just to keep it occupied, but they're good tenants. And, sometimes what we like to ask for, we don't always get it. We want to review the tenants that go in. So when you do get an application, send it to us so we could at least review it and say, okay, good or bad. Now, very rarely does the seller agree to that. But before we close, we make sure we look at every single new tenant that went in the building. And then we say, wait a second, this guy's not credited. This guy, no, I don't want these guys here. The occupancy drops, which allows us to get a credit. So we'll put, anywhere between a $2,000 and $3,000 credit in there. So we'll get a credit at closing, or, so they'll just take it off the purchase price. That's a way to protect yourself for bad tenants going in.
And regarding your earnest money deposit, tell us other ways that you can protect the first kind of investment that you are making, essentially.
Awesome. So the two things that we have is, one, we'll do a 30-day due diligence, typically, sometimes a little bit less, sometimes a little bit more. And we have it clearly spelled out that anything during that first 30 days, our money's 100% refundable. So let's just say you go there and you thought that, the kitchen walls were white and they're gray and you don't like it, you're allowed to walk. You can walk for any reason in the first 30 days. So it's a 30-day due diligence, and anything that you find during due diligence, if you don't like it or it's not what you thought, you can either get a price reduction or you can walk. Or the other thing we put in there is a financing contingency. Now, we don't do that anymore because we've done this for a little while. So we understand we're definitely going to get our financing. It's not a problem. But when I first started, it was a financing contingency. So in our contract, right after the 30-day due diligence, the money technically becomes non-refundable unless you don't get your loan. So you have another 30 days where if you don't get your loan, you get all your money back. And with that financing contingency, we clearly state in the contract, we're looking to secure market rate financing of 80% loan to value or 80% loan to cost. And then if you get a 75% loan to value loan and you don't want to do it, you can get all your money back. So those are two things that we use in all our contracts to protect ourselves.
But I did that in my second LOI, and the comment that I got from the broker is that this makes you look weaker because you're trying to scrape financing for the deal, so it makes you look like you don't have the available funds to close the deal. What are your thoughts on this?
So I tell people all the time, you have to tell the truth. If you lie, you're going to get caught. So I would just tell the broker, no, we don't. I have to go raise the money. Or if let's say you have all the money, you say, listen, I've previewed this to 5 lenders and they've given me ranges between 70 and 80%. So I can't put an 80%, I can't, if I get 70% financing, the deal doesn't work, and then you basically just go back to the broker, show them your underwriting and say, listen, this is the deal at 70%. It makes 8%. At 80%, it makes 11. I have to hit a minimum of a 10 or I can't do this deal because my investors or myself, I don't want that type of return. And if the broker's saying that, he's probably grasping at straws, trying to, force you into doing something you don't want to do. But I tell brokers all the time, listen, I don't need to buy a deal. It's not like the money's burning a hole in my pocket. I buy deals because I want to buy deals. I'm going to buy deals on my term. If you don't like my term and the seller doesn't like my term, maybe I'm not the right buyer for it. Now, if it's the perfect deal and it's everything you want and it checks off every box on your acquisition criteria, it's the perfect vintage, the perfect unit count, the perfect location, and the broker comes back to you and says, listen, it makes you look weaker, well, then that's a personal decision. You could say, you know what, drop it to 70% just because I know I've previewed it to some lenders and they said they can definitely do 70%. But that depends on the type of deal. But we're going through this right now on a property. The broker's pushing me to go higher on my offer or to lower my due diligence. And I just said, listen, it's been a month. We're negotiating this. I'm done. Like, here it is. You go back. I want an answer by Monday at 5 o'clock. If I don't have it, I'm out. And if you come back to me in a week, I'm still out. So you give them, that's a way to push back a little bit. They're basically saying, listen, this is my offer. You have till 5 o'clock to get me an accepted offer or I'm out, and put pressure back on them.
Also, when you have a purchase and sales agreement, when they are clearly stating that we are selling the property as is, you don't accept that, right?
So no, that's typically what they all try and say, because they all try and say, well, I don't know. We say that's fine. It's as to your knowledge, that's fine. But if that being said, if I find something that's wrong, I'm going to walk, and I get that in that first 30 days of due diligence. So if they could sell it as is, that's fine. I'll sign that contract, but that doesn't mean I have to close on it if I find out that the foundation's cracked or all the roofs need to be replaced. Because in my due diligence, it's as is or not. I still have 30 days to go through the property and make sure it's everything I want it to be.
And another thing, and this comes from my personal background, I don't want to be dependent on anyone. And this looks to me like a little bit big boys game, because you are always kind of dependent on brokers to send you deals. And if they look at you as a tire kicker, they're not going to send you anything. So what are some of your strategies for starting to develop deals from alternative routes besides brokers?
So that's an awesome question, because I think there are things that people don't do enough of. We just had a meeting internally with my whole team here, and we just went through an entire list of ways to find deals, because the brokers are great and you need them in this business, because they know every owner, they know every deal. That's their job. But that doesn't mean every deal is going to sell with a broker. So one thing that we do is we'll pull a lot of lists from CoStar or the county website. We'll see who the owners of the properties are, and then we just look up the owners online. We'll say, okay, this guy owns 30 properties. Let's send him a direct mailer. Or one step further, if the guy, let's say it's a New York-based company and I'm in New York, when I'm in the city, I'll go right to their office and knock on the door and say, I'm a principal, we're looking to buy deals, and I see you have 3 deals that fit my criteria. So we'll go direct to the horse's mouth. This just happened to us. We just lost a deal in Greenville, South Carolina. It was brought to me by a broker off market and the owner. I know the owner of the property. We've spoken before. We've looked at 3 or 4 of his deals. So he said, hey, why don't you just reach out to him directly and try and make it happen? So I emailed him yesterday. He wrote back to me, say, hey, we just accepted an offer on that property, but I have a couple other ones. You want to take a look at it? But direct mail is something that's not utilized nearly enough. I think you have more success with direct mail in the mom and pop owners than you do in the institutional or the professionals. But direct mail, cold calling, and direct outreach, whether it's knocking on a door or making a phone call, those are 3 things that we're implementing a relatively large campaign going into 2018 because the market's at a really weird place right now. And a lot of these deals that the brokers are bringing to you aren't selling, and they're just testing the waters and seeing if they can get a high price. So we're going direct to the horse's mouth, with direct marketing, with direct mail, cold calling, and if they are new, wherever they're based, if I'm in that area, or I'll make a trip down to Nashville, Tennessee if I know there are 15 owners there, and I'll just go right to the companies myself. So it's we're taking a very guerrilla marketing type approach because brokers are only going to send you deals they want to send you. They transact a lot of deals, and a lot of buyers don't even get to see them. They'll sell them off market. They'll sell them quietly. They'll bring them to 4 or 5 guys. So you gotta put up or shut up, in lack of a better term, and you got to show track record. And then that's how you start building relationships with brokers. So it's tough, but those are some things that we do.
I'm a cold call guy, and I couldn't care less if you had to pick up the phone to answer me 100 times, because I will do it, because it's all about taking care of my family and my people. So if I have to call you 200 times, I will. So
exactly.
Having said that, one thing that I'm kind of aware is that distressed deals usually kind of they're not the landlords. They are not taking care of the deal because they're kind of sick of it and they are unprofessional, so they want to get rid of it. But if you talk to too many, maybe you can negotiate some favorable terms for them, because they probably will leave. They kind of wanted to send you the property the highest price as possible. That's understandable. But if you talk to lots of them, maybe you can kind of get better terms. I'm talking about comparables. What are your thoughts on this?
Yeah, no, I think you have to. It's we try and look at 5 to 10 deals a week minimum, and that's not the stuff the brokers send us. We try and get 5 or 10 off-market deals a week. That's what we try and shoot for. And you're right. If you can find that older landlord or the guy that's owned it for a while, or the distressed property, or the guy that just doesn't care, if you can get terms to him that are attractive to him, whether it be seller financing or whether he, a way for him to make more money, it works very well. But it's got to work for you, and that's what I tell people all the time. In the bottom line is, you don't ever want to do a deal where you take advantage of someone, right? You want it to be a good deal for both parties.
Sure,
but in the end, like you said, you are looking out for yourself, your family, your people, and everyone that you have to take care of. So you can't buy something that doesn't make sense for you. So you do want to see. I know when we get marketed deals, if a broker sends me a deal, the first thing I do is I look it up online. I see what other communities are around there, and then I'll start calling those guys, because that's a way to maybe strike something up, or maybe you find another property over there that just doesn't like a broker, doesn't want to list with a broker. But yeah, I mean, you gotta talk to 100 landlords to find one that's going to do a deal that makes sense. It's just the velocity of deals and how many deals are actually selling is down so much that it's just hard to find the right deal. And you got to be particular. You can't just buy anything because you want to buy something.
That was my next question. The stuff that we have been getting, it's super overpriced, and we are nearly in a 6 caps and a quarter. And I would like to hear your thoughts on this, because if you were starting out now, you're probably seeing the same difficulty you were seeing as a tire kicker. So they would be sending you deals that were like super overpriced. How would you approach this at this time if you were starting out?
So that's an awesome, and I tell people this all the time, because I have a monthly group that I host, and I tell people all the time, what you have to do is you have to stick to you have to underwrite the way that the deal is going to work, and explain that to the broker. I was a broker, so I know this conversation. If a guy called me and I sent him a deal and I didn't take him seriously. The way that I took people seriously was when they showed credibility and they knew what they were doing. So when a guy would call me and say, listen, I don't own a property. It's my first time I'm buying something. I do need you to walk through this. And, maybe I have repairs and maintenance at, $1,500 a unit when it should be $500 a unit. And if you can walk through your underwriting with the broker, and I do this all the time, brokers will send me a deal and I'll say, listen, you want $27 million. I'm at 24, and this is why. The taxes are going to get reassessed. This is wrong. You're never going to be able to operate a property for, $200 a unit in repairs and maintenance, and I walk through that. Utilities are low because I own 2 properties in the market. This is never going to work. And if you explain that to them, they automatically look at you as saying, okay, that he's one step credible than just a random guy. The other thing that works like a charm is know what you want. Don't just say, send me a good deal, because they're never going to send you. They might send you a good deal. You have to have an outline criteria. It says, this is what, Toro Real Estate Partners buys. What we buy is, 1980s vintage, or, 19 to 2005 to 1970. We want 150 to 350 units. We want properties with, no flat roofs, and we want average rents of $800 to $1,100. We're very specific. We want it in these 5 markets. When you outline that, it shows the brokers that you've actually put thought into this. And, if they send you a deal that's not in that criteria, you could say, listen, this doesn't check off my criteria, but I'll let me give it a quick look for you and see what I think it is. And, I just did the other day, a broker sent me a deal in North Mississippi, right outside of Memphis, not an area that we buy in. And he said, listen, I need, this just fell out of contract. You think you'd like it? And I said, listen, honestly, you're looking for $9 million. I can't even get to $8 million. And I'm not saying that $9 million is a bad deal, but I don't own anything in the area. I have no economies of scale there. I can't get there because I don't have the efficiencies that I would have in a Charleston, South Carolina, or a Greenville, South Carolina. So that's what I told him flat out. I said, listen, and deal broker. And I just said, I can't get there because, I don't know the market well enough. And, I can't just, it might make a lot of money. It might make it was a 7.5 cap. I said, listen, it might make good money, but it's just not for me because it doesn't check off this box, and this box. And he said, thank you very much. I appreciate it. I just want to give the owner some feedback. So you just gotta have your criteria. You gotta explain to the broker why you're offering what you're offering. And then it's a time game. You're never going to build a relationship with a guy on one phone call. It takes time.
I know that, and I always send them my 3-minute offer. I have like this summary summary financials when I look at the deal and say I'm looking for 9% cash on cash for the first year, and we're looking at an IRR if we sell it in like 5-7 years about in the teens, like 13-15%. But most deals don't check these boxes. And if we still get the financing, even if we get like a higher equity, the numbers are not making sense for us. So I like to know is, would you look at different avenues regarding real estate investing? Because it sounds to me it's like the shiny object syndrome, and you'll never kind of finish something that you start, even though you started feeling some difficulties regarding good deals coming your way.
So that's a great question, because you're right. I mean, sometimes I had a friend who was trying to buy property in Tennessee for 3 years. Never bought a deal in Tennessee. Couldn't do it. It just didn't check off the boxes. And they got like tunnel vision, and they didn't want to bend or break. Now, you don't want to have shiny object syndrome either, because you could, I could buy multifamily, and then I could buy industrial, then I could buy fix and flips, and you could go all over the place and never buy anything. So what I tell people is that instead of getting shiny object syndrome, if you want to buy a deal in Houston, Texas, that's fine. But after 6 months, 8 months, if you can't find it, either one of two things. One, you're underwriting it completely wrong. Or two, what you want in that market doesn't exist. So you have to start expanding. You have to pick other markets. You have to get familiar with other markets and try and make that work. If that doesn't work, I tell people all the time, maybe to build credibility, maybe you should think about, either partnering with someone that's done it before or investing in someone's deal. And it doesn't have to be millions and millions of dollars. It could be a $5,000 investment. And then you can say, well, I'm an equity partner, in these 3 deals. And then you can start building a resume that way as well. So there's a couple avenues. Either don't get tunnel vision and start expanding your markets, or find a partner, or invest in a deal. And then you can go talk to brokers. Oh, I own a 200 unit in Houston. I own a 150 unit in Salt Lake City. And then next thing you know, it's like, okay, well, this guy actually has done this before. And you just tell him, listen, I'm an equity partner in this deal. I'm going out. I'm doing my own thing now because I've learned the process. I understand what I have to do. And that's the other way to build credibility. Those 3 ways, I think, will avoid the shiny object syndrome, where one day you're buying notes, next day you're flipping houses, next day you're buying, triple net leases.
So you would always stick to multifamily, even though that you go out of state, and this is what you're saying? You wouldn't never look at medical or commercial shopping malls or something?
So internally, we've spoken about this, and what we want to do is we actually want to get to about 25 to 3,000 units under management in the multifamily space before we go out into a new product class, because we're not experts in that. Now, I've been educating myself in office buildings and other spaces, but what we do is multifamily investments, and now we'll go with the times. 5 years ago, you were able to buy 8 caps that were good deals. That doesn't exist anymore. You're just not going to find an 8 cap that you want to buy. So, we've adjusted. And through that period, we've spoken to our equity partners and we said, listen, the returns we gave you 5 years ago are a lot harder to come by today. But we're still going to buy fundamentally sound investments that check off our boxes. We're going to still do our rigorous due diligence. So, yeah, you're not going to get an 18 IRR or 22 IRR, but you're still going to get, 12 to 15% over a 5 to 7 year hold. That's what we, minimum, now that's what we try and shoot for. Now, sometimes, if it's a real location, okay, we can do a 10, but everything's got to be perfect. But for the most part, we're just becoming more selective. Instead of buying 5-6 deals a year, we're buying 2. And they just got to be they got to be perfect, got to check off all our boxes. And if they do, we'll go forward. If they don't, we'll pass.
Gotcha. And regarding financing, what advice would you give taking care of this? Because from one hand, you're taking care of you kind of the syndicator, so you're taking care of brokers and trying to get leads. But from the other hand, you kind of have your financing ready. So what advice would you give someone starting out to have the financing ready part?
So I always recommend using a mortgage banker or a mortgage broker when you first start. Now listen, you're going to pay for it. You're going to pay them a point, 2 points, depending on the size of the loan, but they're going to put together the pretty package. They're going to present the deal to the bank. It's one less step that you don't have to do. So if you find a good mortgage broker, he's going to do a lot of the heavy lifting for you. And yes, you can go into local community banks and you can go to the agency lenders, and you're not going to pay for it. But you've just added so much work to your workload that, if you're trying to find deals, if you're trying to raise money, if you're trying to manage relationships, and now you're trying to go get lending, you're just making your job harder. And, ideally you want to step back. And if you have a good mortgage broker that can execute, and you send him the deals, he's going to go roll up his sleeves and go get you the best loan. That's what I'd say, but prior to that, get your financials ready, get your balance sheet ready, get your net worth, get that stuff together. So when you do find a deal, you can send it to your mortgage guy. He'll put it together in a pretty package, and he'll go out and do the heavy lifting. So that's my that's my best tip of advice I can give to anybody.
And at this time, since the S&P is super overpriced now and reaching all-time highs, are you underwriting for longer term?
Yes. So all the deals we're doing now, we're really looking at 5 to 10 years, leaning on the 10-year side, because I don't know where we are. You do believe interest rates to go up. So what we want to do now is lock in low rates for as long as we possibly can, with still some type of value component in the deal where we could go in and add a little bit, or, maybe, improve, operations a little bit. But yet for the most part, we're leaning on the longer term deals because it's just more conservative. And, we've done well over the last 5 years, and we want to lock in long term and just sit back and, cash flow and, make as much money as we can.
Actually, I have a question. It's kind of a supply and demand, but I think it's important given the current market conditions. If we have lots of demand and not so many supply, and we have interest rates that are really low, they're pretty trying to stimulate the economy for people to buy. So there's not enough product to sell. Do you think this is a good time for developers for multifamily assets?
So that's a good question. I think development. So we're doing a development right now, and it's our first one. I tell people development is even more critical. The submarket. So if you went on a national level, there's a ton of articles and a ton of publications that show there's not nearly enough supply for the demand that's out there. But you can go to a specific submarket where maybe they've overbuilt it. So development's always a nice option. One, if you can get lending, it's great. Two, if you're in a market like we're doing a development, it's a student housing development. There's no student housing property in the entire market. We're the only one. So supply and demand, we know that we're going to do really well. Development comes down to one thing: it's supply and demand. If you can find a niche where people want it, build it. If you're gonna build a property and they could just go knock on the door next door and knock it down and build it, you want to be a little bit leery. So you just want to understand you want to understand, the code, how it goes. You want to understand that process. If you understand that process, I would say go for it. If you don't know what you're doing, I would say steer away from development because so many things can go wrong.
Okay, it's a different beast from what we're doing, right?
Correct.
Gotcha.
That's for sure.
And regarding advice to your younger self, what would you say?
That's a great question. If I could go back, I would just say I would have told myself to buy more in 2008, 2009. But no, I would just say don't going back, say don't, when you're discouraged or when you feel like it's not going to work, don't give up. Just keep pursuing, just keep pushing, doing what you know is right when maybe you don't know if you know what's right. And educate yourself. Pick up a book and read it. You can't have too much education. But with that being said, don't over-educate yourself and never take action. So take action on what you know. The first deal I did not know what I was doing, and I learned a lot. So just find the right people, surround yourself with the right people, and don't give up. That's what I tell people all the time. I say, when you make 100 calls, I'm going to make 101 calls. And that one call that you don't make is the call that I'm going to make, and I'm going to get a deal. So don't ever give up. Keep pushing forward, and just surround yourself with the right crowd, and don't take no for an answer, and don't let people discourage you.
That's pretty much me.
There you go.
Yeah, and advice for the future. How you see yourself and your company heading forward?
That's an excellent question. What we spoke about internally, we want to be the go-to multifamily investment firm. We want to be the guys that are known, that people say, okay, they're doing it the right way. They're buying fundamentally sound deals. They're buying deals that make sense. They're not forcing a square peg in a round hole. So we're growing, and we want to grow. We set a goal this year to have a $250 million under management. And we're close. And our 5-year goal is to have $1 billion of assets. So that's where we'd like to be.
Gotcha. And I have another question regarding technology. Where do you see the future of basically what we are doing, even that me is an early stage and you're kind of more experienced, but where do you see this avenue regarding the crowdfunding space? How do you see both of them kind of fitting in together?
So that's actually something interesting, because right before I signed on to our webinar or to our podcast, and then I actually had a call come in. That's why I was a little late. One of my investors actually asked me the same thing right before this podcast. So there are a ton of companies that are popping up all over the place crowdfunding. And in 2012, when they had the Jobs Act, from 2012 to 2017, that entire space has changed so drastically. Now, I believe a lot of these companies in business today won't be in business in a couple of years because they're just not doing it the right way. But the companies that are doing it the right way, they will. It's a very attractive avenue. We've actually used it, and it was a test. We tested it on a deal, and we raised $1.5 million in 2 weeks. The deal was a very good deal, but I do believe that technology will continue to improve this business. I do believe that there are intricate ways that they do it. And if they do it the right way, it's an awesome tool to utilize. The one thing I tell everybody is, if you're going to go the crowdfunding that route, just make sure you have a backup plan, because sometimes they fail. But I think that over time, and as time goes on, I think that it will be a very attractive avenue for guys like ourselves in this business. But the big thing that no one says when you do it, if you find a deal, you put it on this website, you raise money. They do a pretty extensive background check, credibility check. Who are you? What have you done? And if you've never done anything, it's going to be a little bit harder to get the deal off the ground. But if you've done stuff in the past, or you can show a track record or a resume or credibility, it's very successful. So I think technology is it's always improving. And I think that there'll be a lot of these companies out of business, but the core ones that are in business, I think they'll continue to plow forward.
Gotcha. And regarding books, share with us some of the books that you've been reading lately.
So I actually just downloaded what was I'm drawing a blank. I know I just finished up, I think Traction's an awesome book. I just finished up that book. Principles is a good book.
By Ray Dalio.
Yes, Ray Dalio. That's the book I just downloaded. And then I just finished. What's the name of that book? I completely forgot. Because I was actually, I got married about a little less than a month ago, and then I was on my honeymoon. So while we're sitting on the beach or whatever, I was listening to some audiobooks, but we were away, and long story short, I forgot what it was. But two books that we're actually implementing traction right now in our business, and Principles is the next book I'm going to be starting. So I heard good things about it. The reviews were good, and Ray Dalio is, he's definitely a different person. So those are the two books I'll go with.
Principles is my all-time favorite book, and
there you go.
It is so kind of logical in his approach to solving problems, kind of in a systematical way. I wasn't surprised when he started developing artificial intelligence kind of machines in his Bridgewater company, because it makes sense when you read the book. You kind of see that a machine could be doing that. So it's kind of an analysis process. So it makes total sense that he has like a lot of computers now in his company. So it's a really great book. You're going to enjoy it.
Yeah. So that's awesome. I'm excited because that's next up on the ticker. But what I've been doing is I've been listening to a lot of podcasts. That's why, I haven't read as many books in the last couple of months, but Principles is next up, and, I'll try and hammer that out, shortly. And I look forward to it.
And finally, where can listeners get a hold of you if they have any further questions?
That's a great question. I think, I don't know if you're going to put it in the show notes, but you can either reach out to me on my email address. You can reach me at John, JOHN, at Toro, TOROREP.com. That's my email address at the office. Or the business line is 516-268-3500. Those are the two best ways to reach me. Leave a voicemail if I don't get back to you. I'll tell you, I'll check them, at least once every 2 days. But email is the best way. John,
thank you for stopping by. Hope to speak with you soon.
Absolutely. Thank you very much. I enjoyed it. And, let's do it again.